Hello friends, welcome back to my YouTube channel, it's Castaway Trader. Today's video is called S&P 500 when 50-day moving average turns from support into the resistance. Before I start the video, please read that important disclaimer. Past results are not indicative of future profits. And today we will be talking about the trend on different time frames. We will be talking about VIX. VIX is a volatility index, and we should always pay attention to what it's doing because normally VIX and S&P 500 are inversely correlated. And in addition to that, we will be talking about this upcoming OPEX week and what does it mean for equities and S&P. But let's start first from a bigger outlook, bigger view. So this is SPY weekly chart, and we can see that on a weekly time frame everything looks rosy and bullish because the previous 3 weeks bears tried to break under 21 EMA, and 21 EMA is the second most important support in a bull market. And you can see that all three attacks were defeated by bulls. They bought out the weakness and they managed to close the previous 3 weeks over that important support of 21 EMA on a weekly chart, and you can see that that support has been pushing the market up since June 2020. But if we switch to a daily time frame, that picture would not be that beautiful. We can see that for a while, since mid-November 2020, the market has been trending up over 50-day moving average. This is that green line, and we can see that numerous times, at least 5 or 6 times, bulls managed to stop bears right at that spot. So that was a great border in between of the bull market and bear market. In addition to that, pay attention to the slope of 50-day moving average. So it was upward slope. This is why it worked as a strong support, because if you have a positive slope of 50-day moving average, it's actually indication that we deal with the bullish market. But look what happened in September, in October. Finally, bears managed to break under support of 50-day moving average. They broke under that support first, and bulls managed to push it back over, but only for 3 days. Then it broke down again, and bulls tried to push up again last week, and you see they failed right at 50-day moving average. And look what happened. 50-day moving average turned from support to resistance for 2 reasons. First, you can see that the last attempt to climb over to reclaim that 50-day moving average failed, and we got that up week on the daily candle, which tells us that there was a bearish intraday reversal. And Friday was a very weak day, which made lower high and lower low. And look what RSI did. We closed with RSI under 50, and basically you can consider 50 as official border in between of bull market and bear market. So this is what normally traditional technical analyst would tell you, and he would tell you that if bulls are unable to break out over 50-day moving average this coming week, most likely we will see another leg down, which would test support of that pink line, which is 200-day moving average. So every time when we break under 50-day moving average, bulls would try to push it back over. If we fail, we would get another leg down. Now let's look at that situation from the perspective of the wave analysis, because wave analysis is the main analytical tool I use for my personal trading. Every time we deal with a corrective pullback, we expect it to be shaped as a simple A down, B up, and C down structure. It looks simple, but what makes it difficult in practice is that the first leg down is itself subdivided into 3 waves, A, B, and C. then we are supposed to get ABC up, and then we could get either ABC down or 5-wave down. Now let's look what ES Mini did and SPY did. We can count that move down in September as a completed corrective structure. We can recognize two major legs down, this one and that one. And under that scenario, if we assume that those two legs were actually two legs which are required for any corrective structure, we are dealing with a new rally which is gradually unfolding in front of our eyes. And tonight we are getting a move down which actually looks corrective because of the top made on Thursday. We got a clean ABC down corrective structure, and basically that corrective structure looks like a bullish wedge. Under that bullish count, the decline we got in September and early October was a corrective bounce that has to be followed by another ABC move up to a new all-time high, where the first leg up would retest the previous high made in September around 45.40. So this is a straightforward, simple bullish scenario. But we can come up with several more scenarios that would be more bearish. And what actually makes us consider more bearish scenarios is that failure at 50-day moving average on daily chart we got on Thursday. Just to remind you that I recently posted another lesson. Last Monday I posted another lesson which was uploaded to my pro course, and in that lesson I discussed in details different scenarios which I continue to discuss in that video. So if you want to dig deeper into those different types of corrective waves, just go to my YouTube channel and watch the previous video, and I will post a link to that previous video in description of that video. Let's move on. We can get much more complex structure. So under a simple structure, ABC down structure, we get two legs down, that is the first leg down and second leg down. But under that WXY corrective structure, we get a more complex pullback in between of the structure. You see that directionless whipsaw, which itself is structured as WXY up. We could get the same structure in that case. And first, let me show you a couple of examples where that structure actually played out, and it was not long ago. First of all, this is a S&P 500 chart, 30-minute chart, which we got in February-March 2021. And yes, it was composed of two legs down, first leg down and second leg down. But look, the first leg down could have been considered as the whole ABC down. But once it started to go up, it failed to make a new higher high. It stopped lower than the preceding top and declined again, bounced again, and finally we got a strong full move down that was the actual leg down. Again, normally in any corrective structure we have two major legs down, and the main question is how we are subdivided and what is the microstructure of them and how we are connected with what structure. It could be simple ABC up, or it could be such a complex WXY structure. If you want to learn in details the harmonic Elliott wave theory, which I keep referring to, you can go to my website www.castawaytrader.com education, and I would recommend you to start with intermediate video course where I will explain you all the basics of the harmonic Elliott wave theory, and you will learn all main fractals. And the idea behind the application of the harmonic Elliott wave theory in trading is that we try to identify a model fractal in the real chart, and once we identify the fractal in play, we would be able to extrapolate and we would be able to make focus about what's going to happen next. And that is another example of a complex WXY corrective structure that happened in SPY daily chart September-November 2016. It was like 5 years ago. and it looked really similar to what we have now. Look, we got the first move down, it broke under 50-day moving average, then bulls managed to push it over just for one day, then it dropped down again and we tried to push up again and we failed 4 times in a row. So there were 4 attempts of bulls to push price back over 50-day moving average. But after we spent a couple of weeks after the 50-day moving average, it was enough for that 50-day moving average to change its slope from positive first to neutral, so it became horizontal, and then it started to move down. And when 50-day moving average starts to move down, it starts to work as resistance. It starts to push pressure on prices. And look, where was the final failed attempt of bulls to push it over? We left a doji candle, sign of indecision, and then we started the final leg down, which was structured as ABC, A down, B up, and C down. And look, because 50-day moving average stopped working as support and turned into the resistance, what would be the next level of interest? That would be 200-day moving average, and this is exactly where bears pushed the price, and it happened in early November 2016. Let's come back to the current situation. On Thursday last week, bulls pushed up, and at that point we actually got enough waves to consider that wave X up to be completed. So what it means is that we got the first leg down and that we got a WXY pullback, which could be followed by another leg down in the very same way as it played out in 2016. If you look at that model, we are somewhere here. S&P 500 can start pushing down and it will drag 50-day moving average down. Let's look again at the WXY structure. That's the first leg down, W up, X down, and Y up. And the main question here at the beginning of a new trading week: have we actually topped in that subwave Y of wave X? Because if we topped and that decline is just the beginning of a new leg down. Another possibility under that bearish scenario is that bulls will try to push higher again and will try to retest that red target box again, maybe even couple of times. And if we come back to the 2016 case, you will see that bulls hit 50-day moving average 4 times and we failed 4 times. Again, at that point, 50-day moving average works as resistance, and as long as bears manage to keep bulls under that 50-day moving average, which is for SPY stands at 442.80, we can expect continuation under the bearish WXY structure, where we should expect another leg down, and SPY would be the same target, 200-day moving average, which currently stands at 414.40. And by the way, pay attention to RSI 50. You can see that RSI kept holding under 50, which is an official bearish territory. If you want to learn more, not only about the main tenets of the harmonic Elliott wave theory, but about the way how you apply the wave principle in trading, you should try my second video course, How to Trade Like a Pro. Again, you will read details about that course on my website www.castawaytrader.com, education, and there you will read information about my pro course. There is one more important consideration we should keep in our minds. That week, that coming week, is OPEX week. That means that would be the 3rd Friday of the month when weekly and monthly options will expire. And there is well-established bullish seasonality for that OPEX week. So here you can see a study I found in the web that shows that October OPEX Friday has the 2nd strongest bullish seasonality in a year. In particular, if you would buy, on average, if you would buy on Monday of an OPEX week and sell on Friday of an OPEX week, your chances to make money would be on average more than 70%, and your profit factor would be 1.9, meaning that even average gain would be much bigger than your average loss. So out of 32 trades, backtesting tells us that 23 trades would have been profitable. Normally, Monday and Tuesday of an OPEX week, this is the time when bears can push price down. Wednesday could come as a reversal day, and traditionally Thursday normally becomes the strongest day of an OPEX week. On Friday, sometimes we get continuation, but sometimes we get the highest point on Friday morning at the open, and sometimes on Friday price starts to go down. So that bullish seasonality, the window is quite narrow, so we could say Wednesday and Thursday and sometimes Friday morning is the most bullish time of an OPEX week, and Monday and Tuesday normally is the weakest time window. This is when bears try to push price down. And if we come back to 2016 case, you will see exactly how that phenomenon worked out. You see that doji that was actually Friday OPEX, and you can see that price reached the highest point over that OPEX week on Thursday. And look at Monday and Tuesday, they were big red days, but price managed to recover on Wednesday and Thursday, and on Friday it was weaker than on Thursday. On Monday it opened even lower, and the peak was made on Tuesday, the week following after OPEX week. And look what happened then. After OPEX week, price started to decline. And the explanation is quite simple, because big guys, big option dealers, they make money by selling you options. For them, options is like an insurance. They are not interested in any big moves before those options expire. So they want the options they have written for you guys, for retail traders, to expire worthless. And for them, the best scenario is a very flat OPEX week. So the lower magnitude of moves, the better for them, because the best for them if that week does not go anywhere. This is when premium of those options would collapse, and they would pocket all the money they got from you when you buy protective puts. But once OPEX week is over, the fourth week of the month is great time to start moving the market either up or down, because we have not written too much puts by that moment. Let's come back to the current situation again, and we can see that that current decline looks like a bullish wedge. That actually tells me that we can expect bulls to step in again and start pushing higher again. And we could even expect, I would expect, that bulls would be able to push price higher, a little bit higher than the high made last Thursday. And that would be ideal. The ideal scenario would be to see bulls pushing up to 50-day moving average, which is currently stands at 44.25. But we should understand that we still have a bullish scenario on the table, and if bulls manage to push ES over 44.45, it's 66.7% retracement of the whole corrective move down which we got in September and October. That would be a warning sign for bears. That could be a sign that actually bearish scenario is not longer valid, because again at that point, as long as bears keep the market under 50-day moving average, we can seriously consider that bearish scenario where we are going to get the second leg down. But under the first bullish scenario, we have already got both legs down, that one and that one. And this is how 30-minute ES mini chart looks right now, you see that I had my green target box in between 43.58 and 43.37, and this is exactly where bears pushed ES mini right into the green target box, and from that point bulls can keep pushing it higher into Thursday or Friday morning. That would be a typical intra-week seasonality which we normally see for ES mini, S&P 500 on an OPEX week. I have one more very important topic, especially for those traders who love to trade volatility, VXX, UVXY, and that topic is about VIX index. The VIX index is an index that measures market estimate of expected volatility of S&P 500 index. It is calculated by using the midpoint of real-time option bid-ask quotes. So basically VIX, it's not a stock, it's not an ETF, it's a product of formula, calculation of formula, and it takes into consideration how much premium traders are willing to pay for call options versus put options. This is a really good way to measure, to estimate sentiment of the market. And because VIX is essentially measures fear and greed of traders, when the market starts to go down, VIX thrives in that condition and it goes up. Because we have been dealing with the bull market for the previous 10 years, normally VIX would go down, and when we have a temporary pullback in S&P 500, we would get a similar ABC up pullback in VIX index. And here I would show you two traditional ways how VIX would make a pullback, and this is VIX pullback in August-October 2020. Again, normally as in any corrective structure, we would have two legs up. Again, remember, if S&P 500 stock produces a corrective pullback, it makes two legs down because the prevailing trend is up. For VIX, the prevailing trend was down. This is why when we deal with a corrective pullback, we normally get two legs up. We got W up and Y up, and ABC structure, which is wave Y in between. Another WXY corrective structure was recorded in November 2020, February 2021. Again, we can clearly identify two legs up, which were interconnected by ABC structure in between. Those two legs up we label as W, Y, and ABC structure in between. That was wave X. But as I've mentioned, sometimes we are lucky to get very clean ABC corrective structure, but sometimes we have more complex corrective structures. And this is one of those cases. In April 2021, VIX produced much more complex corrective structure, which is called the expanded triangle corrective structure. That structure is composed of 5 waves. 3 of them were up, Z1, A, C, and E, and they were connected by 2 legs down, that was wave B and wave D. And all waves in that structure were by themselves composed of 3 waves. You see those ABCs: ABC up, ABC down, ABC up, ABC down, A up, B down, and C up. And that was the completion. Under the expanded triangle corrective structure, the third final spike is the strongest one. It comes as a very strong, like crazy rally. Look, that final rally was almost twice as bigger as the previous one. The thing is that currently I see similarity of what VIX is doing now to what we got in April 2021. Let me show you. Look, this is what we got at the moment. We got 2 legs up, they are highlighted in green, A up and C up, and we got 2 ABC down structures that would connect waves A and C and waves C and E. And you can see here that that structure would allow that one final crazy move up in final wave A. But before we can expect that strong move up, VIX looks like it needs to make one more lower low, because those structures in those red squares, they should be working as A down, B up, C down, or WXY, whereas the second leg down should make a lower low under the low made by the first leg down. Look, that leg down made lower low in comparison to the first leg down, and that leg down should make a lower low in comparison to that leg down. That actually beautifully fits the scenario I've just explained you for S&P. We have just discussed that ES Mini, S&P, and SPY could make one more push high. And if we get that one more push higher, that would be exactly what VIX needs to make one more push lower. And if we get one more push lower to something like 1650, but we need any lower low under 1760, which was the previous low made by VIX at the end of September, that would be enough to complete the WXY structure. And in contrast, the protective stop for that scenario is 1568. If VIX drops under 1568, the structure would not longer be weighted. But I would point your attention to the fact that that decline retraced 90.2% of the preceding move up, and for that particular case, if you would expect that we would get a similarity and that red box would erase 90.2% of the preceding green box, that would be 1650. So if we hit 1650, we could consider going long volatility, or we could consider going short S&P 500 by buying puts with a very tight stop where VIX drops under 1568. We have just reviewed two counts of ES Mini and VIX, and we can see that scenario argues for VIX to leak lower to complete subwave Y or wave D down before the strongest rally in wave E can start. That provides bulls with more time to push SPX, SPY, ES higher, or at least to hold it steady, helping VIX to deflate and reach its target. Thank you for your time. Please like this video, that would encourage me to record more videos and video lessons. And please subscribe to my YouTube channel, that means a lot to me. Thank you.